It made absolute logical sense for us. Then I think a month later, Glencore said, do you want to buy the balance of Ernest Henry? And we said, absolutely. We didn't worry about how are we going to do this? How are we going to integrate it? We just said yes. We did that deal in about 2 months. We were building the Cal Underground. We were having challenges at Red Lake. Well, I put pressure on the company, but make no apology for that. If you're in a cyclical business, you want to be ready, nimble, and able to act when the opportunity arises.
G'day, money miners. Date is it? Wednesday?
Wednesday. It feels like a Friday. I hope it's... Oh, mate. Oh.
It's Wednesday. We're tuning in from day 3 at Digit in Devonales.
Thank God it's the last day.
Got a bit of a treat for the money miners. Wicked conversation we just had.
That was interesting. I don't know how after the video we put up yesterday was completely zero value to anyone listening. But today we've actually got something valuable to listen to, and that is Jake Klein of Evolution. The executive chairman of Evolution has grown that company into the behemoth it is over 10 years, I think maybe 12 years, all the way from conquest through to evolution, the M&A that they've undertaken to grow that. It's quite remarkable. They took a lot away from that one. I also can't believe we managed to get A-list MDs come on our podcast after we just uploaded absolute rubbish yesterday, mate. Oh gosh.
Thanks. Who's first up? JP Search.
Mate. Yeah, good on these guys, Xavier and Michael. They're recruiting, investment bankers, and the likes, management consultants, analysts, etc. Working.
Start jobs. If you're coming from the corporate side or individuals as well, it's been all sorts of roles. Get in touch with the guys at JP.
Yeah, and even if you're a corporate that needs someone, but get in touch with those guys because they have a good network of talent to talk to.
Cheers, guys.
And the other one, mate. What else we got to plug today? Terra Capital. Oh, geez. I actually sent these guys a text message this morning almost apologising for our degenerate content that we've been uploading and said, I apologise if there's any brand damage to you guys. And they go, nah, love it. It's the best brand association we've ever had. So,
Bondi, Lenny, Dylan, cheers, guys.
Thanks, guys. G'day, Jake Klein. We're bloody thrilled to have you here. You've joined us, surprisingly, given that our content this week has been absolutely C-list level, and now we've got an A-lister with us, Jonas. I'm thrilled about it, but
we're excited to have you on, Jake.
You really improved the quality of our content for this week, so thanks for joining us.
You guys must be in sales. keep going with the compliments.
Well, speaking of compliments, we heard you've been given plenty of compliments about your speech today. We're not in the same boat as everyone else. That just as soon as you get off stage, tells you great speech. We had a read of it. Didn't have the opportunity to watch it live, but we read it, and it's all about you're making the case for gold to be cool again a lot of ways. And I think the backdrop of what everyone's talking about is all of these sexy critical minerals, and gold doesn't fit into that category. But why is now the time to care about gold?
Well, I think because those sexy critical minerals are overvalued at the moment. So, there's been a huge amount of momentum going into them. I watched a number of the presentations. It all looks and sounds good, but there's a lot of money that needs to be spent to actually getting a lot of those mines and producers to profitability. So gold is the barbaric relic. It's a store of value. I put up a few slides which I think are going to be catalysts for the gold price and positive catalysts. The one is US debt levels. It started out at $40 billion after World War II. It's now $31 trillion and rising at $100 million an hour. So, I said by the end of tonight, off the conference, depending on what time you stay till tonight, it'll be $1 billion higher, maybe a bit higher for you guys.
We both had a look at that slide, and we had a good look at it and thought, he's the CEO or the executive chairman of the gold company now, a macroeconomist. But then we saw you didn't adjust for inflation, all this other stuff. So no, he's still an executive chairman of a gold company.
I think gold's a much better investment than people are giving it credit for at the moment. So I think it has lost a bit of its aura. I think there are fewer gold investors. ETFs have been a big growing part of that, I think. But gold offers very high margins, very good cash flow, and can generate great returns.
Jake, on the flip side on that, you've got to balance it with a bit of a copper aspect to your portfolio as well. What do you sort of make of, the rumours and stuff we see, Barrick going for First Quantum, and gold businesses eyeing off copper players?
Well, we were very lucky to buy Ernest Henry. I mean, it just came along. I'd looked at Cadia for a long time and realised that, how do they get such low costs? Yeah, they got a huge copper credit in what's really almost a copper mine. So we thought, well, why don't we copy Newcrest? And we were looking around for a project with a credit. Ernest Henry came along at the time when Glencore was going through a real existential debt crisis. Ivan Glasenberg, their CEO at the time, said, you've got to deleverage, and the copper group was given a very tight time frame to get some money in. And we offered them a deal where we effectively bought the gold content of Ernest Henry and 30% of the copper, and we paid them $880 million up front. And then, they decided that, 30,000 tons of copper, which is half the economics, because it changed. The deal changed as you went below the 1,200 level, where we're heading to now, where we owned half the copper. So 20 to 30,000 tons of copper is not really relevant to Glencore, so they sold us the rest. So we're very happy to own 100% of Ernest Henry. We like copper. The challenge with a gold company having a lot of copper exposure is that the capital requirements for a big, low-cost copper mine are higher than a gold mine. So it'll be interesting to see whether gold companies can really bridge that gap and become large copper producers as well as gold.
Speak of that deliberate strategy to acquire an asset with a credit, and when the public thinks about evolution, they think at face value, low all-in sustaining cost, and we all know under the numbers that all-in sustaining cost is driven by this large copper credit by virtue of Ernest Henry. Tell me about the thinking that goes into wanting the messaging to be about low cost via credit. It seems like it was a very deliberate part of the strategy, the acquisition strategy. It was a thoughtful piece of the marketing message.
So I've always believed that the gold industry has had this bias towards trying to grow production. Every quarterly report starts with production ounces, and analysts start with miss or exceeded guidance or ounces. I think it's wrong. I'm not sure that gold is a scalable industry. So we've kind of said the mid-tier space, 6 to 8 assets is the right space. The rationale behind that is saying, is there really synergy between an asset on different locations around the globe? We don't think so. So a concentrated portfolio of high-quality assets has always been our bias, and we've said, we've taken, again, it's kind of a bit of a learning from, Buffett saying, build a moat, make sure that if you're in a cyclical business, that you can withstand the cyclicality. There are good times in the gold business, there's bad times. So building a portfolio of assets that really deliver high margins, and if you can try and ignore the number of ounces you produce, and whether you report it as a byproduct credit or copper tons or gold, it doesn't really matter. It's how much cash are you generating and how much margin are you making on the capital you're deploying.
Jake, so on the sort of number of assets and things, I want to dig into that a bit more. You said not too long ago, and just now again, you're looking for 6 to 8 assets. And Evolution, to your credit, has done a good job at sort of going from stepping stones in assets, expanding. First up, what does a Evolution sort of asset look like? You've spoken about looking at what the majors are potentially selling. What's the perfect Evolution asset?
So it changes over time, because remember, we formed Evolution with some assets which were non-core for Newcrest at the time, and we put them together with Mount Carlton, and which was in Conquest, and we had Edna May in Catalpa. We only have Mount Rawdon left out of that core group of assets. So we're big believers that a gold company's job is really to manage a small, highly concentrated portfolio of assets. And the challenge is not becoming too emotionally attached to these assets, because there's a time in a journey of a company where those assets become non-core. And I think our playbook has been taking assets out of majors. Majors put themselves in good geological positions, but in a portfolio of assets, everyone's competing for capital. So if you go to Cal or you go to Ernest Henry and you speak to geologists on the ground, they'd say they were motivating to drill the holes that we've been drilling now that have made these discoveries and things when they were in Barrick or Glencore's portfolio. They just didn't get traction. And we've probably had the same in our organization, where Edna May or Cracker or assets like that have not got the geological spend that they needed because they didn't rank. So we're big believers in selling assets as well as buying assets. Make sure you're not embarrassed when you sell an asset that someone makes the next big discovery, like the Swan Zone at Fosterville. So we always have a contingent payment and a royalty or something like that. But it's probably better off in other assets. Unfortunately, to date, we haven't been embarrassed.
So I want to hone in on Red Lake now. Evolution, like many other Aussie gold miners, went to Canada. And, looking at it, here we are in mid-2023, it hasn't gone as smoothly as a lot of companies would have hoped. What are the main lessons from the last few years of acquisitions into Canada and North America?
Yeah, so I spent the first part of my career in China, trying to build gold mines in remote parts of China, and we succeeded there. It takes a lot of effort and time. It should be easier in Canada, and it is easier. They're good miners. We speak the same language, but there are still cultural differences. It doesn't help when you're locked out of the mine that you've acquired for the first 18 months due to COVID. But fundamentally, we've put ourselves in a position where there's a massive endowment. There's 12 million ounces. The cultural change required at that mine site has been more challenging than we expected and bigger than we expected. It was an asset that was really depleted by Goldcorp and then by Newmont, were just caretakers. So for 5 years, it just sat in the portfolio without getting any money. If you speak to people at Red Lake, they would say that they funded all of Goldcorp's other assets. But when they ran out of the high-grade zone, and there's history to Red Lake that's important to its future, they didn't get the money back to actually convert the operation into a lower-grade, more productive asset. So what I'm convinced of is that we've put ourselves in a geological position, 12 million ounces. It's worth the effort. The effort has been harder than we expected, but the reward is going to be worth it.
Jake, you speak to this philosophy of acquiring assets from majors as they become non-core is an important part of Evolution's investment thesis. Yeah. When you look at the merger between Newmont and Newcrest, are you almost anticipating assets to be spun out of that would be attractive to Evolution?
We've said publicly that yes, Tom Palmer has said that they're interested in, or they will be selling some of their non-core assets, and we'll look at them. Whether they present opportunities. The challenge which we've got at the moment is that we've actually upgraded our portfolio of assets to a point where some of our assets should be interesting to majors. Ernest Henry has a 17-year mine life ahead of it. It generated over $300 million of cash flow for us last year. The challenge in this sector is that as you get better assets, it gets more difficult to improve the quality of your portfolio. We're committed to that, but it is harder.
At which point, I almost think that Ernest Henry in some ways makes Evolution a little bit vulnerable to the goldies who are needing copper exposure to stay relevant, or there's a perception that the pure play gold companies are going to be vulnerable to the next in row of the ESG sort of debate, because there's no value in gold. You're making the case for a renaissance in gold, but because Evolution has some copper exposure, it might be more interesting to merge with a pure play gold company in that respect. How do you think about that theme evolving in the gold major market?
I don't think ESG is going to be a big impediment to the gold industry. I think the S and the G we're very good at. So then you go to the E part and the carbon footprints and the need to mine gold. First of all, our emissions are not very large. Second of all, I think we can get to net zero, but we need the government to get the grid to renewable, because 70% of our emissions are using grinding media, vent fans and things like that, which if we could get that power as renewable power, those would be zero emissions. Then you've got trucks and things and diesel, which are scope 1 emissions. We need the OEMs to deliver us the next generation of fleet, which will be electric. And speaking to Caterpillar and other OEMs, they will deliver that. So I don't think the carbon footprint, subject to the government delivering a renewable grid, and that's the subject too, because I think that target is very aggressive from the Australian government perspective. I don't think gold's going to have an issue with getting to its targets.
So what do you make of the likes of Bellevue going hard at this green gold thematic?
I think it sounds good. It's interesting, but I'd like to hear from them when an investor's prepared to pay more for that green gold.
I'll tell you that they're developing the market for the green gold.
And that's good. We're going to be fast followers, and once they establish the premium, we'll be delivering inserts.
Yeah.
Oh no, that's funny, Drew. You spoke before about the Warren Buffett philosophy of investing around cyclical industries. I'm looking back in the history of Evolution's M&A, the deals that the company's done, and there've been periods where Evolution's announced 3 insane deals in 3 months or something like that. I mean, there's a degree of nimbleness to act when the opportunities are there that Evolution has had historically, which has allowed it to have a competitive advantage to create value from M&A. I guess my question is, what enabled Evolution to have that capability during that period of time, and is that a factor that's still present in the company, or is it dissipated as you've grown?
No, it's definitely present. I mean, I'd say the thing which has challenged us in the past couple of years has been our operational delivery. When you're not delivering operationally, it makes it more challenging. And clearly, I created the circumstances which put a lot of pressure on the company. We were, the first deal we did in 2021 was with Northern Star, was selling Kundana. It made absolute logical sense for us. Then I think a month later, Glencore said, "Do you want to buy the balance of Ernest Henry?" And we said, "Absolutely." We didn't worry about how are we going to do this? How are we going to integrate it? We just said yes. We did that deal in about 2 months. We were building the Cowal Underground. We were having challenges at Red Lake. So I've put pressure on the company, but make no apology for that. If you're in a cyclical business, you want to be ready, nimble, and able to act when the opportunity arises. I think the real challenge for the gold industry, and why investors have been disappointed time and time again, has been that we act like a herd. When it's popular to do deals, we do them. And when the gold price is rising, everyone talks about growth, and this is great. But you should actually be doing things when things aren't that good, and when it's actually more difficult to do them, and when you're being counter-cyclical.
If you want to avoid group things, don't come to evening deals, man.
I'm not going to the evening functions.
You go. I just wanted to touch on the M&A once more. Is there jurisdictions Evolution rules out off the cuff?
Yeah, so as I said, I spent the first part of my career building gold mines in China when globalization was a thematic. China and Australia were like best of friends, and it was all going to be, happy for everyone. We've gone through now what is almost a decade of deglobalization, and when I started in China in the 90s, China knew that they needed access to raw materials. They now know categorically that they can't get security of that supply, or ownership of that supply from places like Australia and Canada. So they've gone to Africa, and they've gone to developing countries where they've used diplomacy, they've used debt to really access those assets. So if you're operating in Africa today, your competition is likely to be Chinese groups. And it's not just Chinese government. China has, over the last 25 years, grown formidable global commodity companies. Zijin, Jiaojin, Jiangxi Copper, those are companies that you should not think of as old-style Chinese companies. They are international companies. They are very competitive, and they have a different country risk profile to what our investor base would have.
I think when the commodity investor universe thinks about the geopolitical dynamics and how they're impacting the resources industry today, the first implication that they think about is how it flows through to the battery metals industries. There's not much conversation or thought into how the current geopolitical dynamics will flow through into the gold market. Do you have a view on that?
I think my view is that it will have more of an impact on the gold price, because there's a slide in my presentation deck that talks about central bank being net sellers, pre the decoupling in 2010, and now they're net buyers. And that's not the US government or the Australian government's central banks buying gold. It's more of the emerging developing countries that are buying gold and want to decouple from the US dollar. So I think it will have more of an impact on the gold price. I think we're in, if you really start entering a polarized world where there's potential conflict, and let's face it, there's a war on in Ukraine at the moment. And it was only, I think, 4 years ago, when was Trump president, that he was saying that he could do business with Putin. I don't think Joe Biden's saying that anymore. You've got a situation where there's much, much more risk in the world. So investors are going to have to focus on country risk. Now, in the gold space, if you want to go to emerging and interesting geology, you've got to go to developing countries. Barrick has gone down that path, and they're investing a lot of money in Pakistan, for geology, not for country security. Our approach is different. We actually think that it's better to go down the path of good jurisdictions and find districts and opportunities that you can consolidate and make money out of.
So in focusing on those companies, the mid-cap sort of gold tier, something that we noticed and spoke about a lot in the last couple of weeks is the margin and the cash flow that these companies are making. And it's quite glaringly obvious to us that a lot of the companies in Africa, they're trading on very cheap multiples, but they were actually making money, the likes of WOF, Perseus, Emerald in Cambodia and stuff, versus in Australia we've seen probably at the smaller end, but some companies go bust in a near record gold price environment because the costs are just so unsustainable. So I guess the first sort of question is, are costs flattening out for you guys across the business right now?
Yeah, but let's just start with the heart of your question. There are too many gold producers, and gold companies put too much money into assets that are never going to make money. You need a lot of gold, geology is the fundamental of any of these acquisitions or any of these developments. You need to get enough gold to get your return on capital. And I was at Macquarie. You were there as well. This is 30 years ago, way before your time. But we pioneered gold hedging and lending to small companies, and I think we created a culture in Australia that meant that small explorers, developers wanted to become producers. You could hedge. The strategy or the pitch was, and Macquarie made a lot of money at that time out of interest rates of 15%. Basically getting companies to prove up enough reserves, lend them the money. You could get a very low-cost plant, which Minproc or Senko would build for like $30 or $40 million. And then generally you would discover more ounces because you'd only really touch the top of those discoveries. I think the challenge here now is that costs have gone up a lot, capital intensity is higher, and you're not finding the additional ounces that you need to make those investments much more profitable.
When I was at Macquarie, Jake, one of my jobs as a junior banker there is every earnings season you write a letter to the CEOs and the chairperson's letter, and we all know none of you read them, but it was an annoying thing we all had to do. Can you please just confirm for all of the junior investment bankers out there that you never read the earnings letters from the board back at banks?
I haven't got them. Or they're going to spam. I don't know.
We wrote one to you. So. What a waste of time that was.
There you go.
And I'll wrap up. I'm just curious to get, Jake, your most contrarian view within the gold sector. Like if you were to benchmark your views against all of the other gold leaders in the space, what is your most contrarian view versus their consensus?
Forget about the number of ounces you're producing. There's this absolute fixation on the top line. Worry more about the bottom line and your return on capital, and treat gold like any other business. And that means only putting money into the things that actually are going to give you a return, and stop being emotional about these assets. They take a lot of time and effort to get into production. Yes, there is a commitment and desire to make things work, but do not fall in love with your assets. Love the people who work at the assets, but do not love the assets that you can't disconnect yourself from those assets.
Beautiful. Thanks a lot for your time, Jake. I really appreciate it.
Appreciate that, Jake.
Thanks, guys.
All right, Trav, how was that, mate? Great chat.
Awesome. Pretty spectacular insight.
Lining for us. We'll keep getting A-listers for our C-list performance.
Who's the next A-lister we want to bring on? Who would you love to speak with?
Mate, there's a few in the works, but we'll keep the money mine and spend.
All right.
Brad, we just want to say cheers to all our partners out there, JP Search, Anytime Exploration Services, the guys at Terra Capital.
K-Drill.
That's it.
Beautiful. Appreciate it, guys. Thank you very much.
No worries.
One more thing, JD.
Yeah.
Big thank you to Dee Benali's Kalgoorlie. These guys have let us set up inside their restaurant / bar / pub / cafe, which is where we are filming right now, as you can see, for the last 3 days. Oh, what a legend. Thanks, Luciano.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation, or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation, and needs.